Skyler, give us your own sense on how you're looking at the whole U.S. versus rest of the world trade right now, sitting where you are.
Yeah, there's still a lot going on here in the United States in terms of AI, in terms of a very strong consumer and a very strong corporate balance sheets. Corporate balance sheets have the least amount of leverage they've ever had in history. We're sitting at 19, 20% debt to equity. Consumers are in an extremely good spot. Consumer net wealth in the United States has grown 50% since COVID, just over the last 5 years. So consumer net wealth I think the U.S. net wealth is at about $160 trillion. And so there's a lot of dry powder. But in order for consumers and corporations to expend that dry powder, they need to get a little bit of comfort. Okay, so what has done well thus far this year? Obviously, Europe, Germany lifting their borrowing and really talking about spending a tremendous amount of money and borrowing to do that. So you have defense, you have European economy doing extremely well, at least for the past couple of months. And frankly, the rest of the world's benefited from a weaker dollar this year. So you're looking at Asia that hasn't done that great to start the year yet, but on a currency adjusted basis, it's done fairly okay, much better than the U.S. because the dollar is weakening.
And how much more do you think the dollar can weaken from here? Do you think this is structural weakness or just cyclical?
We're at 104, from a top of, call it 110, 111. I think we can get to 98, 99 bucks, and still feel fine. And, what I think the government cares about is bringing down borrowing costs and doing what they think is fair, which is evening out trade surpluses one way or the other. And so they're going to break some things here for the next few months, and then I think it's full sailing ahead.
So if the dollar does stay weak, Skyler, that's definitely going to put upward pressure on imported inflation at a time when, of course, the tariffs are already putting upward pressure on prices across the board. Might the Fed be in a difficult spot? And while it seems to be in wait-and-see mode right now, when it comes off that mode, might the next move be a hike?
Oh, for sure. And I've been one of the only folks that have been talking about this for the last year or so now. The Fed cut interest rates September of last year, about 6 months ago. They've cut rates about 100 basis points. And here we're back again. Financial conditions are easing. Generally, consumers and corporations are in a really good spot. They have a lot of money to spend. And if there's clarity, they will. And inflation will rear its ugly head again. And that could come from tariffs as well. And so, if you look at what the Fed said last week, and if you look at what they communicated via their dot plots, via where they say, and they write this down every quarter, where they say employment is going, which is lower, unemployment, where they say inflation is going, which is staying about where it's at, not getting below 2 for at least the next 2 to 3 years.